Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ALAB.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. ALAB is really sitting at this perfect intersection of high-performance computing and, the massive AI build-out we're all watching.
Right.
And for the longest time, a whole story around this company was just pure growth. A great narrative, sure, but it was a company that was basically burning cash to grab market share.
A classic tech growth story.
Exactly. But the analysis we're seeing now, it suggests a really monumental shift. I mean, they've pivoted from being a high-growth speculation to a self-sufficient, profitable infrastructure play.
And that pivot, that's really the core of the bull case right now, isn't it? When we actually dive into the financials, the evidence is it's just overwhelming.
It is.
Especially if you look at the first quarter of 2025. Their Q1 revenue came in at an incredible $124.7 million.
And that's a 104% increase year over year, which is already fantastic. But crucially, it just blew past what the consensus of analysts were projecting.
So this isn't just growth, it's accelerating growth, unexpected growth.
And it's the consistency that validates the story. This strong Q1, it wasn't just a one-off. It came right after a really robust Q4 in 2024.
Okay.
But the real structural change is in what is driving that revenue. Their core focus, the AI connectivity products. We're talking about things like their smart NIs, their intelligent cable systems. That part of the business generated $98.2 million.
Wow, so that's nearly 4/5 of their total revenue.
Almost 80%. And that segment's growth was a staggering 137% year over year.
And for listeners who might not be deep into data center infrastructure, when we say smart nights, we mean these specialized network cards, right? They offload tasks from the main CPU to manage and speed up traffic inside these huge AI clusters.
You've got it. They're basically the specialized traffic cops making sure data moves smoothly and, more importantly, fast between thousands of GPUs.
So the fact that this is almost 80% of their revenue, that just confirms Astra is absolutely vital to the big hyperscalers, your AWS, Meta, Google Cloud, as they build out their newest AI infrastructure.
Exactly. And that shift in the revenue mix, it has a direct, very positive impact on the next key metric we have to look at, margins.
Because these AI products are more specialized.
They're proprietary and specialized, so they command higher prices and, you guessed it, higher margins. We saw the gross margin expand sequentially in Q1 to 56.8%.
Which is great.
But the metric that really truly defines this inflection point is the operating margin. Astra achieved a positive 2.1% operating margin in Q1.
Okay, that's huge. For a company that just IPO'd, to hit their first positive operating margin, that's a landmark moment. It changes the entire financial story.
It completely validates the business model. They're no longer just relying on future debt or issuing more stock to fund their operations. They've achieved operational self-sufficiency.
And their balance sheet backs that up.
Yeah.
I mean, they're sitting on a fortress of $478.5 million in cash.
With zero debt.
With zero debt. That gives them an incredible runway for R&D or, to weather any kind of slowdown.
And the whole financial health argument is just sealed by the free cash flow turn. Q1 was their second consecutive quarter of positive FCF. They delivered $19.4 million.
And that was after, what, $14 million in Q4?
$14.1 million in Q4 2024. So consistent positive FCF. It means the company's core operations are generating more cash than they consume. It's the ultimate signal that they've gone from a promising science experiment into a mature, functioning business.
And you can see management feels it too. They're putting their money where their mouth is, right?
Yeah.
They announced that $100 million share buyback program.
And they've already executed almost $29 million of it.
The important thing for us to note here is when they bought those shares, the average price was well below current market levels. That tells you the people who are closest to the company, they truly believe their stock is undervalued. That's always a powerful signal.
It is. So moving beyond the raw financials, the second crucial pillar here, and I would argue the most compelling long-term story, is the competitive moat they're building.
Right.
The edge isn't just a single chip. It's their proprietary silicon IP combined with this system-level integration. They don't just sell you a component. They sell the full stack, what they call the AI fabric.
And that includes everything, the core chip, the cables, the software.
Everything, from the core silicon like their Astra chip, all the way down to the intelligent cables and the diagnostic software.
So they control the entire data pathway inside the AI cluster. That has to be what gives them the technical edge.
Precisely. They're the ones optimizing that handshake between all those incredibly expensive GPUs, and this is something you can actually measure.
Okay.
The company has a formidable IP portfolio. We're talking 72 granted U.S. patents and another 47 pending. And that deep integration lets them deliver tangible performance improvements. We've seen external benchmarks that show a latency reduction of around 18% in their clusters compared to competitors.
18%. In a world where speed is everything for AI, that's a massive number.
It's huge. And it leads directly to this idea of stickiness, which is what every investor is looking for.
How hard is it for a hyperscaler to just rip and replace Astra's fabric once it's in?
It's extremely difficult, and this is the heart of their advantage, why the stock probably deserves a premium multiple. Hyperscalers like Meta and AWS, they don't just plug these chips in, they incorporate the entire platform into their custom rack designs.
So it's baked into their architecture.
Deeply baked in. If they wanted to switch to a competitor, they would have to revalidate the entire server stack. That means testing, certifying, stress-proofing every single component working together again from scratch.
And that's not a quick process.
That validation cycle alone takes 9 to 12 months. And the associated costs, when you factor in engineering time, resources, potential delays, it's estimated to be over $20 million per cluster.
Wow. So it's not just the price of a new part, it's the $20 million cost of 9 months of engineering paralysis and opportunity cost just to tear out a system that's already working.
That's a powerful deterrent, and it's why their full-stack approach is so much better than many rivals who are, silicon pure or cable pure, but not both. By controlling the whole ecosystem, Astra can guarantee a lower total cost of ownership, which is the single most important metric for customers managing billion-dollar data centers.
They're not just selling speed, they're selling certainty and efficiency. That builds a durable moat. Okay, so let's talk about how this strong fundamental story is actually translating into the market. If the fundamentals are this good, we should be seeing money follow.
And we are. Technically, Astera confirmed a really important structural breakout back in May. It pushed definitively above that $52.50 resistance level.
And that move wasn't just noise, right? It was on high volume.
Exactly. It was accompanied by high institutional volume, which is a classic signal of accumulation, big money moving in and taking durable positions for the long haul.
And for the chart watchers out there, we saw that classic long-term momentum signal. The golden cross was confirmed in mid-May.
Right. For our listeners, a golden cross is when that short-term trend, usually the 50-day moving average, crosses above the long-term trend, the 200-day. It's not a short-term timing tool, but it's a very robust signal that the market's belief in the long-term story has fundamentally shifted to bullish.
And beyond the charts, the sentiment just backs this all up. We've seen the bears basically retreating.
Significantly. Short interest, that's the percentage of shares being bet against, it's dropped dramatically. From over 8% in November to just 4.1% recently in June. When the bears lose conviction, that selling pressure eases up.
And then you have the insider buying, which makes the story even cleaner. We saw the CEO and the CFO step in and make substantial open market purchases.
Over $1.4 million worth in April and May. And when the executives who know the order book and the R&D pipeline better than anyone are putting their own personal cash on the line, well, it speaks volumes.
It's the institutional money lining up perfectly with that internal belief. Big firms like BlackRock and Vanguard, they significantly up their stakes in Q1.
Which aligns perfectly with the shift we've seen in the analyst community. Multiple major firms, JP Morgan, Goldman Sachs, Piper Sandler, they've either started coverage with high ratings or they've aggressively raised their price targets. And what they all cite is that improved gross margin visibility and Astra's leadership in this AI fabric market.
And that confidence seems well placed because Astra is clearly not resting on its laurels. We saw new product validation just in May. They announced the Astra 3 chip.
Right, the Astra 3, that's their third-generation AI smart NIC, and it offers a massive 400 gigabits per second of throughput. But here's the real kicker.
What's that?
It's already sampling with the top 3 U.S. hyperscalers. So this confirms they are maintaining that aggressive pace of IP development you need to stay ahead. They're proving they have the pipeline for the next generation of AI infrastructure.
Okay, so we have the financial inflection, a durable moat, strong market sentiment. Let's pivot now to the forward look. What are the key near-term catalysts we should be watching? And of course, where are the risks?
The most immediate catalyst is the Q2 2025 earnings report. We're expecting that around July 30th. Consensus revenue is sitting around 132 million.
But the market's going to be focused on more than just the top line.
Oh, absolutely. The focus will be extremely narrow. Free cash flow and guidance. The street wants to see FCF come in above that projected $20 million mark, and they'll be looking for management to raise Q3 guidance, confirming the acceleration is real.
And outside of earnings, there are some other visibility events coming up.
Yes. In August, Astra is confirmed to publicly demo that new Astra 3 chip fully integrated inside the Meta infrastructure stack at the AI and HPC Summit in San Jose.
That's huge for confidence, seeing the product working seamlessly inside critical customers' architecture.
It really is. And, we can't ignore the macro tailwinds. There's increasing talk about potential U.S. CHAPS Act funding. Since Astra has extensive U.S.-based design centers, they could qualify for some of those incentives.
Which would be a nice non-dilutive boost to their R&D budget.
Okay, now for the counter-argument. Where's the risk? You can't talk about high-growth AI without talking about customer concentration.
Absolutely not. And that is still the biggest structural risk to the bull case. The concentration of revenue. The top 3 customers, Meta, AWS, and Google, accounted for 73% of Q1 revenue.
That's a big number.
It's a significant concentration. So if there's any delay in, say, the mass deployment of PCIe Gen 6, which is the next-gen tech their products are built for, or if just one of those 3 hyperscalers decides to slow their build-out, it could severely impact revenue targets.
So a delay in a technical standard could stall their sales cycle. Makes sense. But are they doing anything to mitigate that reliance?
They are, and the efforts are showing real results. They're actively diversifying into non-hyperscaler enterprise wins. We're talking telecom, defense contractors, high-performance computing.
And how's that going? It's still a smaller piece of the pie, just over 12 million in Q1, but revenue from those segments grew 120% year over year. So that diversification, that's the long-term answer to tempering the concentration risk.
What about margin risk? If the AI boom slows, could margins get compressed?
It's a secondary risk, but one to watch. If AI demand were to suddenly and severely slow down, the revenue mix could shift back toward their legacy products, which carry lower margins, but the current trend really mitigates that. The AI segment is growing twice as fast as legacy, and management is guiding that legacy business down to under 5% of total revenue by late 2026.
So they're actively managing the mix. Overall, management's confidence just seems extremely high, especially with that raised full-year guidance. They're now projecting between 520 and 540 million for 2025.
Which implies sustained year-over-year growth of over 60%. And when you combine that revenue growth with the margin expansion, well, you see, analysts have just drastically narrowed the projected loss per share for 2025. The path to sustained profitability looks much shorter than anyone thought.
It's a really compelling story.
Astra Labs really represents this unique moment in AI infrastructure investing. You have proprietary, defensible tech with high switching costs, you have accelerating revenue, and critically, that proven positive free cash flow inflection. I think the question you should really be mulling over is whether Astra can maintain this aggressive pace of innovation to defend its silicon moat against those vertically integrated giants, the ones who are trying to own every single layer of the data center stack themselves.
That is the essential trade-off to consider. If you want more in-depth analyses like this one, remember to subscribe to Smart Wealth with Joshua for your daily stock and catalyst stocks.